Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational and entertainment purposes only. The information provided is based on extensive research and personal experience, but it should not be considered professional financial advice. Always do your own research and consult with a qualified professional before making any decisions about your insurance coverage. You are being ripped off. I'm not saying that to be dramatic, I'm saying it because for the vast majority of drivers in California, it is the simple statistical truth. You are likely overpaying for your car insurance by hundreds, if not thousands of dollars every single year. And the worst part? The insurance companies are counting on you never figuring it out. They've built a multi-billion-dollar empire on a system that is intentionally confusing, deliberately opaque, and designed from the ground up to profit from your loyalty and your busy life. But that all ends today. This video and the series that follows is your playbook. This is the insider's guide to smashing through their system, taking back control, and cutting your car insurance bill down to the absolute bare bones minimum required by law, without sacrificing the coverage you actually need. Let me tell you about Mark. Mark is a 42-year-old software developer living in San Diego. He's got a perfect driving record. Not a single ticket or accident in over a decade. He drives a reliable 2021 Honda Accord. For 7 years, he was with the same big-name insurance company, the one with the catchy commercials you see every 5 minutes. His bill for 2 cars was about $2,400 a year. He thought that was a fair price. He was a valued customer, a safe driver. He got his little loyalty discount every 6 months. Then, his neighbor, who drives the exact same model year Accord and has a similar driving record, mentioned he was paying just $1,400 a year. $1,000 less. Mark was floored. How was that possible? He spent the next weekend in a rabbit hole of comparison websites and phone calls, and by Sunday night, he had a new policy with even better coverage for $1,350 a year. He saved over $1,000 with just a few hours of work. Mark's story isn't an exception. It's the norm in California. The only difference is most people never have that conversation with their neighbor. They just keep paying the bill, assuming they're getting a fair deal. That assumption is costing you a fortune. This isn't just another list of the top 5 cheapest insurance companies. Those videos are useless. They're outdated the moment they're uploaded because rates change daily. Instead, this is a masterclass. We are going to arm you with knowledge, the one thing the insurance industry fears most. We're going to dissect the 2026 California insurance market piece by piece. I'll show you the secret rating factors that have a massive impact on your premium that aren't even listed on the quote forms. We'll expose the so-called discounts that are really just marketing gimmicks and focus on the ones that actually move the needle. I will give you a word-for-word negotiation script to use when you're on the phone with an agent, a script designed to dismantle their objections and unlock unpublished rates. By the time you finish this series, you won't just have a cheaper insurance bill. You will understand the game so completely that you will never overpay for car insurance again for the rest of your life. For years, I was just like Mark. I saw my auto insurance payment as a fixed utility, like water or electricity, came out of my bank account and I just accepted it. I had been with the same company since I was 20 years old. I thought my loyalty meant something. I was wrong. It meant I was a target. After a minor parking lot fender bender, literally a 5-mile-per-hour tap that barely scratched the paint, my rates shot up by 40%. 40%. For being a loyal customer for over a decade. That's when I got obsessed. I decided I was going to learn this system inside and out. I spent the next 6 months reading through dense filings from the California Department of Insurance. I interviewed 3 former insurance agents who agreed to speak off the record, and I ran over 200 different quote scenarios for myself, my friends, and my family, tweaking every single variable to see what would happen. The results were staggering. What I discovered is that the price you pay for car insurance has less to do with how you drive and more to do with how you shop. The entire system is a psychological maze, and the insurance giants are holding the map. They prey on something called price inertia. They know you're busy. They know you don't want to spend your Saturday filling out long, tedious forms. They know you hate being on the phone. So they make it easy to sign up and then slowly, methodically, they raise your rates. A little 5% bump here, a 7% increase there. It's called the loyalty tax, and it's one of the most profitable anti-consumer practices in the industry. They're betting that your rate increase will be just small enough that you'll grumble about it, but won't actually go through the hassle of switching. And for millions of Californians, that bet pays off year after year after year. And the complexity is a feature, not a bug. They bombard you with jargon, comprehensive collision, bodily injury liability, stacking MedPay, uninsured motorist property damage. It's designed to overwhelm you, to make you feel like you need an expert to guide you. So you just throw your hands up and say, okay, just give me the standard package. That standard package is where their highest profit margins are hidden. It's often loaded with coverage you don't need or priced in a way that provides minimal value for maximum cost. California's market is especially predatory because it's so massive and diverse. The rate for a driver in Eureka can be fundamentally different from one in Bakersfield, even if every other detail is identical. Regional risk assessments, local repair costs, and even the litigation rates in your specific county are all being calculated by an algorithm that is a complete black box to the consumer. They have all the data. You have none. We're going to change that. This series is your equalizer. We're going to break down every single line item on your policy declaration page. We'll explain what it is, why it matters, and how much you really need based on your specific situation. We're going to talk about deductibles and how choosing the right number can save you 20% overnight. We'll cover the specific discounts available only to Californians, like the Good Student Discount and the Mature Driver Improvement Course Discount, and show you how to stack them for maximum effect. We'll even explore the rise of telematics and usage-based insurance, those little plug-in devices or phone apps that track your driving. Are they a brilliant way to save money or a dangerous invasion of privacy that can be used against you? We'll give you the unvarnished truth so you can decide for yourself. We're going to turn you into the insurance company's worst nightmare, an educated consumer. A consumer who can't be tricked by slick advertising, who isn't fooled by confusing terminology, and who refuses to pay the loyalty tax. You work hard for your money. It's time to stop giving it away for free to a company that sees you as nothing more than a number in a profit and loss statement. So, if you are ready to stop guessing and start saving, you are in the right place. The first thing we need to tackle is the absolute cornerstone of your insurance rate. It is the single most important factor in the state of California, and it's almost certainly not what you think it is. It's not your car. It's not your driving history. It's not your age. It's something far more fundamental, and once you understand how the insurance companies use it, you'll hold the first key to unlocking hundreds, if not thousands, in savings. Let's get into it. It's your zip code. That 5-digit number you write on every form without a second thought. To an insurance company, it's not just a location. It's a crystal ball. It's the single most powerful predictor they use to determine how much of a risk you are, often weighing more heavily than your own driving record. And in a state as vast and varied as California, the difference between one zip code and another, sometimes just a single street over, can mean a staggering difference in your premium. Let me tell you a story about two people. Let's call them Alex and Ben. They are, for all intents and purposes, the same person to an insurance underwriter. Both are 35 years old. Both drive the exact same 2024 Honda Accord, a silver LX model. Both have spotless driving records. No tickets, no accidents, not even a parking violation in the last 10 years. They have identical credit scores, both in the excellent range. They even have the same job as graphic designers, and they commute a similar distance to work. They're both single, they both rent their apartments, and they are both requesting the exact same coverage limits: $100,000, $300,000, $50,000. Bodily injury and property damage, with the same comprehensive and collision deductibles. From a risk perspective, they are clones. You would expect their insurance quotes to be virtually identical, right? Maybe a few dollars difference here or there. But when they shopped for insurance in the spring of 2026, Alex was quoted an average of $175 a month. Ben, on the other hand, received quotes averaging $340 a month. That's nearly double. We're talking about a difference of almost $2,000 a year for the exact same driver with the exact same car and the exact same coverage. What was the one single variable that created this massive gap? Alex lives in Irvine, zip code 92604. Ben lives about 50 miles north in downtown Los Angeles, zip code 90014. This isn't a fluke. This is the system working exactly as it was designed. It's a practice called territorial rating, and it's the bedrock of auto insurance pricing. Insurance companies are, at their core, data companies. They spend billions of dollars collecting and analyzing vast oceans of information to predict the future. And the data tells them with brutal statistical certainty that where you park your car at night is a more reliable indicator of your likelihood to file a claim than almost anything else about you as an individual. So what are they seeing when they look at Ben's 90014 that they don't see in Alex's 92604? It boils down to a few key factors. First, and most obviously, is claim frequency. Insurers track every single claim, from a minor fender bender to a multi-car pileup, and they pin it to a map. Over time, they build a detailed, block-by-block history of accidents. Ben's neighborhood in downtown LA is a dense, bustling urban core. More cars, more intersections, more pedestrians, more chaos. Statistically, there are simply more accidents per square mile there than in the sprawling master-planned suburbs of Irvine. So, even though Ben himself has never caused an accident, he lives in an accident hotspot. He is paying a premium for the statistical sins of his neighbors. He's more likely to be hit by someone else, and the insurance company prices that risk into his policy. Second is crime. Specifically, vehicle-related crime. Insurance companies have access to detailed crime statistics from local police departments and national databases. They know exactly how many cars are stolen, broken into, or vandalized in every zip code in the country. If Ben's zip code has a higher rate of auto theft than Alex's, his comprehensive coverage, the part of his policy that covers theft, is going to be significantly more expensive. Again, it doesn't matter that Ben religiously locks his car and parks in a secured garage. He lives in an area where the risk is higher, so his price is higher. Third is population density and traffic patterns. This is related to claim frequency, but it's more about the potential for incidents. A dense urban area like downtown LA means more cars are on the road at all times. It means more stop-and-go traffic, which is a breeding ground for rear-end collisions. It means more cars parked on the street, vulnerable to sideswipes and hit-and-runs. Irvine, by contrast, was designed with wide streets and ample parking. The traffic flow is generally smoother. The data shows that this difference in urban design translates directly into a different level of risk. Fourth, and this is a surprising one for many people, is litigation rates. In some areas, there is a higher tendency for accidents to result in lawsuits. Whether it's due to the local legal culture or other socioeconomic factors, insurers know that a simple accident in one zip code might be settled for a few $1,000s, while the exact same type of accident in another zip code is more likely to end up in a prolonged, expensive court battle with lawyers involved. This potential for higher legal and settlement costs is priced directly into the premiums for everyone living in that high litigation zone. And finally, there's the cost of repairs. The cost of labor and parts can vary from one area to another. A body shop in a high-rent district might charge more per hour than one in a less expensive area. This can influence the collision portion of your premium, as the insurer anticipates what it will cost them to fix your car, or someone else's car that you hit, in that specific geographic area. When you combine all of these factors, the history of accidents, the rate of theft, the traffic density, the legal environment, and repair costs, you get a risk profile for each zip code. The insurance company's algorithm takes one look at Ben's 90014 and sees red flags everywhere. It sees a history of frequent claims, higher crime, and costly settlements. Sees risk. When it looks at Alex's 92604, it sees a sea of green flags. It sees stability, safety, and predictability. This is the cold, hard math of the insurance industry. Feels deeply unfair because it is. You can be the most cautious, defensive, and responsible driver on the planet, but if you live on the wrong side of a boundary line drawn by an actuary in an office 1,000 miles away, you will be financially penalized for it. You are judged not by the content of your character, but by the location of your garage. Now, the obvious question that arises from all this is, okay, this is frustrating, but what am I supposed to do about it? I can't just pack up and move to Irvine to save $1,000 a year on my car insurance. And you are absolutely right. For 99% of people, moving is not a practical solution. Seems like a trap. Your location is fixed, so your high rates are fixed too, right? Wrong. This is where we move from understanding the problem to exploiting the system. Because while you can't easily change your zip code, there are powerful strategies you can use to change how the insurance company perceives and prices your location. There are nuances within their own rules that most people have no idea exist. In fact, one of the most effective strategies has to do with a single line item on your policy application that most people fill out on autopilot without a second thought. Getting this one specific detail right can, in some cases, dramatically alter the territory they place you in, unlocking savings you thought were impossible without a moving truck. And that is exactly what we are going to dive into next. So, let's talk about this concept of a territory. In the world of car insurance, Your territory is the single most powerful factor in determining your base rate, especially here in California. It's the foundation upon which everything else, your driving record, your car, your age, is built. And most people make a critical mistake. They think their territory is just their zip code. That is fundamentally wrong. Thinking your zip code is your territory is like thinking your country is your street address. It's a starting point, but the real details, the ones that cost you or save you a fortune, are far more granular. Insurance companies invest hundreds of millions of dollars into data. They slice and dice every square mile of California into thousands of unique rating territories. These aren't zip codes. They're invisible proprietary maps that overlay our cities and towns. A single zip code like 90210 in Beverly Hills or 94110 in San Francisco's Mission District might contain 5, 10, or even 15 different territories. One side of a street could be in Territory A, while the other side is in Territory B. And the difference in cost between Territory A and Territory B isn't $5 or $10 a month. It can be a staggering $40, $50, or even over $100 a month per car. Why? Because the data tells them everything. They know the exact frequency of accidents at the intersection a block from your house. They know the auto theft rates for your specific apartment complex. They know the number of claims related to vandalism, flooding, and even uninsured motorists within a few square blocks of where you park your car at night. They are not insuring you based on your city. They are insuring you based on your precise location on the planet. Your garaging address is the epicenter of their risk calculation. This brings us to the crucial detail I mentioned. The secret isn't about lying or using a fake address. Let me be crystal clear. That's insurance fraud, and it will get you in a world of trouble. The secret is about being meticulously, almost obsessively accurate about your garaging address, because the slightest, most legitimate variation can place you in a completely different and dramatically cheaper territory. Let me tell you about a guy named David. David lives in a large apartment complex in San Diego, the kind of place that takes up an entire city block. His mailing address, the one on his driver's license and his bills, is 123 Main Street. So, naturally, for years he used 123 Main Street when getting insurance quotes. His rates were always high, but he just figured, hey, it's California, it's expensive. He was paying around $280 a month for his Honda Accord. One day he was talking to a neighbor who lived in the same building, had a similar car, and a comparable driving record. The neighbor mentioned he was paying closer to $190 a month. David was floored. How was that possible? He grilled his neighbor, who finally shrugged and said, I don't know, man, I just put in my address. But David fixated on one small detail. The underground parking garage for their complex wasn't accessed from Main Street. Main Street was a busy, 6-lane commercial road with bus stops and heavy traffic. The garage entrance, the physical location where his car actually spent its nights, was around the corner on a quiet little side street called Elm Avenue. The address for that entrance was technically 450 Elm Avenue. On a whim, David went online to get a new quote. He filled out everything exactly the same. Same car, same driving history, same coverage limits. But this time, when it asked for his garaging address, he didn't put his mailing address of 123 Main Street. He put the technically more accurate address of where the car was physically kept, 450 Elm Avenue. He clicked Get Quote. The system spun for a moment, and the number that came back was $195 a month, an $85 a month savings, over $1,000 a year. What happened? The insurance company's algorithm saw Main Street and flagged it as a high-risk territory. It was associated with high traffic volume, more commercial activity, more potential for sideswipes, break-ins, and accidents. Elm Avenue, just 200 feet away, was flagged as a quiet residential street. Lower traffic, lower risk, lower crime stats. It was in a completely different, much cheaper territory. David wasn't lying. His car was garaged at 450 Elm Avenue. He had just been using a less precise and far more expensive version of his address. This isn't just about massive apartment complexes. This applies to so many situations. Do you live on a corner lot? Your house might have a mailing address on the busy street, but a driveway and garage that open onto the quiet side street. Which one are you using? You need to check which one is the more accurate representation of where your car is parked. Are you on the border of a zip code? Sometimes a single property line can straddle two. One of those zip codes might be in a significantly more favorable rating zone. You can use the official USPS address lookup tool online to see what recognized, official addresses are associated with your property. There might be a valid alternative that saves you a fortune. The key is to think like an underwriter. They want to know the precise location of the asset they are insuring when it is at rest. So ask yourself, where does my car actually sleep? If you have a designated parking spot, what is the closest physical address to that spot? If you park in a driveway, what street is that driveway on? Never ever use a P.O. box or a mailbox store address. That's an instant red flag and can lead to policy cancellation or denial of a claim. You must use a physical residential address. But your goal is to find the most accurate and advantageous one that is legally and truthfully yours. So here's your homework. Go to Google Maps. Type in your address. Now switch to satellite view. Look at your property. Where is your garage? Where is your driveway? Where do you actually park? Is it on a different street than your front door? Is there a more precise address for your parking structure? Do a little bit of detective work. Then when you're shopping for quotes, run the quote with your mailing address, and then run an identical quote using the more precise garaging address, if one applies. See what happens. For many of you, especially in dense urban areas like Los Angeles, the Bay Area, San Diego, or Sacramento, the difference will be shocking. You could be leaving hundreds, if not thousands, of dollars on the table simply because you're using an address of convenience instead of an address of precision. Getting the where right is the first monumental step. Sets the baseline. But once the insurance company has pinpointed your car's location on their risk map, their focus immediately shifts to the next critical question. It's no longer about where the car is, but about who is behind the wheel. They need to build a risk profile for every single licensed driver in your household. And the way they do this, the way they rate a 17-year-old new driver versus a 45-year-old with a perfect record, is filled with traps and counterintuitive strategies that can either double your premium or, if you know the secrets, actually cut it down. In fact, you'd be amazed to learn that sometimes, adding a specific type of driver to your policy can trigger a discount that makes your overall bill go down. It defies all logic, but it's a powerful strategy the pros use, and it's exactly what we're breaking down next. Okay, let's talk about the insurance industry's weirdest paradox, the one that feels like a glitch in the system. How can adding another person, another potential risk, to your policy actually make it cheaper? The answer lies in how insurance companies calculate what they call household risk. They aren't just insuring you. They're insuring the entire environment your car lives in. And when you add a specific type of driver, you can fundamentally change their entire calculation in your favor. Think of it like this. Imagine you're a single 22-year-old male. To an insurance algorithm, you are a walking, talking red flag. It doesn't matter if you're the most responsible 22-year-old on the planet. Statistically, your demographic group gets into more accidents. You are by default a high-risk bet. Now let's say you live at home with your parents. You decide to add your 55-year-old mother to your policy as a listed driver. She has a 35-year unblemished driving record. She's never had a ticket, never had an at-fault accident. Suddenly, the algorithm's entire perspective shifts. It's no longer just looking at a high-risk 22-year-old in isolation. It's now looking at a multi-driver household that is anchored by an extremely low-risk, stable, experienced driver. The computer model makes a few key assumptions. First, it assumes this experienced driver will occasionally use the car, reducing the total miles driven by the high-risk individual. Second, and this is more of a psychological factor baked into the data, it assumes the presence of an older, responsible driver in the household has a moderating influence. It suggests a more stable home environment, which, believe it or not, is a factor they consider. The premium drop doesn't come from your mom's risk profile replacing yours. You are still the primary driver, and your risk is still the main factor. The discount comes from the fact that her pristine record dilutes the overall risk of the policy. She is a stabilizing anchor, whose presence tells the insurer that the car is in a lower risk environment than if you were living alone. The overall risk score of the household goes down, and so does your premium. This is the anchor driver strategy, and it's one of the most powerful and underutilized tools available, especially for younger drivers in California. The key requirement is that the person you add must live at the same address. You can't just add your uncle who lives in another state. This is about the people who have regular access to the vehicle because they share a home with you. This could be a parent, a spouse, a domestic partner, or even a long-term roommate with a stellar driving record. Let's walk through a real-world California scenario. Meet Carlos, a 24-year-old software developer living in Irvine. He has a clean record, but because of his age and the fact that he's financing a newer Honda Civic, his insurance quotes are coming back at around $300 a month. Brutal. He lives with his girlfriend, who is 25 and also has a perfect driving record. They keep their finances separate and she has her own car and her own insurance policy. On a whim, when getting an online quote, Carlos tries adding her as a listed driver on his policy. He makes sure to keep himself listed as the primary driver of the Civic. The system asks for her driver's license number and driving history. He plugs it in. The new quote comes back. $240 a month. A $60 a month savings or $720 a year, just for acknowledging the other low-risk driver in his household. Why? Because the insurance company now sees two responsible young adults with clean records sharing a household, which is statistically a much safer bet than a single young male. It changes the entire context of the policy. Now let's look at a different, even more counterintuitive version of this: the good student stack. This applies to families with teenage drivers, which, as any parent in California knows, is an absolute insurance nightmare. Let's say the Miller family in Fresno has one 17-year-old son, Tom, on their policy. Adding him shot their 6-month premium up by over $1,000. It's a financial gut punch. Tom is an average student, a B-, so he doesn't qualify for the good student discount, which typically requires a 3.0 GPA or AB average. Here's the crazy part. The Millers also have a 16-year-old daughter, Sarah, who isn't driving yet but will be next year. She's a straight-A student. Just for the sake of experiment, Mr. Miller gets a quote to add Sarah to the policy now, as a licensed driver, even though she won't have her own car. He lists her as a secondary driver on her mom's minivan. The algorithm now has to process a completely new situation. Instead of one high-risk teenage driver with no discounts, it sees a multi-car, multi-driver family policy with two young drivers. But one of them, Sarah, comes with a hefty good student discount which can be anywhere from 10 to 25%. Furthermore, adding a third driver might trigger a slightly larger multi-driver discount. The system re-evaluates the entire household. The massive penalty for the first teenage driver is now partially offset by the significant discounts brought in by the second teenage driver. In some very specific cases, the combination of the good student discount and other stack discounts can be so large that the final premium is lower with two teens than it was with just one. It defies common sense, but it's all about how the rigid automated quoting systems are programmed to balance risks and rewards. You are essentially arbitraging the discounts. You're adding a risk, a second teen driver, that happens to unlock a discount that is greater than the cost of that added risk. Now, before you rush off to add your entire family to your policy, there are critical rules you have to follow. This is not a loophole for fraud. It's a strategy for accurately representing your household to get the best possible rate. First and most importantly, be truthful about who the primary driver of each vehicle is. If you're a 25-year-old driving a Mustang to work every day, and you add your 60-year-old father to the policy to get a discount, you cannot list him as the primary driver of the Mustang. That is a form of insurance fraud called rate evasion. If you get into an accident, and the insurance company investigates and finds out you lied, they can deny your claim and cancel your policy, leaving you with a massive bill and a black mark on your record that will make it incredibly difficult and expensive to get insurance in the future. The strategy is to add them as an additional or secondary driver, not to misrepresent the main user of the car. Second, the person you add must have a clean driving record. This strategy is about adding a low-risk anchor. If you add your roommate who has 2 DUIs and a speeding ticket, I guarantee you your rates will not go down. They will skyrocket. You will be actively telling the insurance company that your car is now in a higher risk environment. Run a background check on anyone you're considering adding if you're not sure. Third, as we mentioned, they must reside at your address. The entire premise is based on shared household risk. Insurers have ways of verifying addresses, and if you're found to be listing someone who lives across the state, that's another form of misrepresentation that can get you in serious trouble. So, how do you actually do this? It's simple. The next time you're getting an online quote or talking to an agent, run the numbers both ways. First, get a quote with just yourself. Save it. Then, go back and get a second quote, this time adding the other licensed, clean record drivers in your household. Compare the two. It won't work every single time. Sometimes it will make the rate go up slightly, but for a significant number of people, especially younger drivers or families, this simple act of accurately listing all the low-risk drivers in the home can unlock hundreds, if not thousands, of dollars in savings. You are simply giving the insurance company a more complete and, in these cases, more favorable picture of your car's life. You've now optimized who is on your policy, But what about what is on your policy? Most people just accept the default coverages the insurance company website suggests, but this is where they hide the profit-padding extras. There are specific coverages that millions of Californians pay for every single month that are either completely redundant or that they can literally never use. It's like paying for a swimming pool in an apartment that doesn't have one. Identifying and eliminating this phantom coverage is the next critical step to cutting your bill down to the bone, and it's exactly what we're exposing next. Let's start with the easiest, most common piece of phantom coverage: rental car reimbursement. On the surface, it sounds smart. If your car is in the shop after an accident, your insurance pays for a rental. It usually costs between $5 and $15 a month. That doesn't sound like much, but it's potentially $180 a year for something you might already have or simply don't need. Let me introduce you to Mark. Mark lives in Fresno, he's 42, married with one kid, and drives a 2018 Honda Accord. His wife drives a Toyota Sienna minivan. Mark was paying $12 a month for rental reimbursement. That's $144 a year. When we looked at his policy, I asked him one simple question. Mark, if your Accord is in the shop for a week, what's your plan? He looked at me, confused, and said, well, I just drive my wife's van to work. She works from home, so it's usually just sitting in the driveway. Boom. Phantom coverage. Mark was paying for a solution to a problem he didn't have. He had a built-in backup car. So here's the checklist for you. Pull out your policy declarations page right now. Find the line item that says, rental reimbursement, or substitute transportation. Now ask yourself these 3 questions. 1. Do I have a second car in my household that I could use in an emergency? 2. Do I work from home or have access to public transit, making a car non-essential for a short period? 3. Do I have a premium credit card like an Amex Platinum or Chase Sapphire Reserve, or a membership like AAA Premier? Many of these services offer complimentary rental car benefits that you're already paying for. If you answered yes to any of those, you are very likely burning money. For Mark, cutting this was an instant $144 back in his pocket. Next on the phantom coverage hit list, roadside assistance. Again, it sounds like a no-brainer. For a few bucks a month, you get towing, a jump start, or help if you lock your keys in the car. Most insurance companies charge about $3 to $8 a month for this. But here's the catch. It is one of the most redundant coverages in existence. It's the B-list celebrity of insurance add-ons. It shows up everywhere. Let's go back to Mark in Fresno. He was paying $6 a month, $72 a year, for his insurance company's roadside assistance. But Mark also had a AAA Plus membership, which his wife bought him for Christmas 2 years ago. He was literally paying 2 different companies for the exact same service. He was double-dipped. This is incredibly common. Before you pay your insurer for this, check everywhere else. First, check your car manufacturer. If you bought your car new or certified pre-owned in the last few years, you almost certainly have complimentary roadside assistance. Toyota Care, Ford Pass, Hyundai Assurance, they all have it. Second, check your credit cards. Many travel cards and even standard cashback cards from major banks include roadside assistance as a free perk. Third, check your cell phone provider. Yes, companies like Verizon and AT&T sometimes bundle this into their higher tier plans. You are probably already covered for towing and jump starts, maybe from 3 different sources, and you're still paying your car insurance company for a 4th. Find that line item on your policy. It might be called towing and labor. If you have coverage elsewhere, cut it. For Mark, that was another $72 a year saved. We're now up to $216 in annual savings, and we haven't even gotten to the juicy stuff yet. This next one is my favorite because it feels like a genuine magic trick. It's called Custom Parts and Equipment Coverage, or CPE. This is insurance for aftermarket parts that you've added to your car, things like expensive custom rims, a booming stereo system, a spoiler, or a custom paint job. Standard policies don't cover these things, so you have to add a special rider for them. And here's the scam. Agents and online systems in California will often add a minimum level of CPE coverage, say for $1,000 or $5,000, to your policy by default. They assume you might have some custom parts and just bake it into the quote. Mark's 2018 Honda Accord is completely stock. It's exactly as it came from the factory. He hasn't changed a thing. Yet, buried in his policy was a $5,000 CPE rider. He was paying $14 a month to insure custom rims and a stereo system that did not exist. He was insuring ghost equipment. This is the absolute definition of phantom coverage. It provided him with zero value because you can't make a claim on equipment you don't own. It was a pure 100% waste of money. That's an extra $168 a year for nothing. I want you to go through your policy with a fine-tooth comb and find this. If you drive a standard unmodified car, a stock Toyota Camry, a Honda CR-V, a Ford Explorer, and you see a line item for custom parts and equipment, you need to call your agent immediately and demand to know why it's there. Get it removed. For Mark, this discovery brought his total annual savings to $384. That's a real dinner out every single month, just from eliminating waste on a policy he already had. Okay, let's talk about the last and most complex piece of phantom coverage: medical payments, or MedPay. This one requires careful thought because for some people it's essential, but for many others it's highly redundant. MedPay is a type of no-fault medical coverage. If you're in an accident, it pays for your and your passenger's immediate medical expenses like an ambulance ride or emergency room visit, up to a certain limit, usually between $1,000 and $10,000. It pays out quickly regardless of who was at fault. The phantom overlap here is with your personal health insurance. Let's look at Mark one last time. He has a good PPO health insurance plan from his job. His health insurance deductible is $1,000. On his car insurance, he was paying for $5,000 of MedPay coverage. Think about that. If he gets into an accident and has $3,000 in medical bills, he has two options. He could use his MedPay, which he's paying extra for every month. Or he could use his regular health insurance, pay his $1,000 deductible, and have the rest covered by the plan he already has. He is essentially paying a premium for a secondary, and frankly inferior health plan that only works in a car accident. Now, here is the critical warning. This is not advice for everyone. If you have a very high deductible health plan like one of those $8,000 catastrophic plans, then MedPay is a fantastic, affordable way to cover that gap. If you don't have any health insurance at all, MedPay is an absolute necessity. And if you frequently drive with passengers who may not have their own health insurance, keeping MedPay is a responsible and caring thing to do, as it will cover them too. But if you are like Mark, if you have a solid health insurance plan with a manageable deductible, and you mostly drive alone or with family who are also on your good health plan, you are likely overinsured. You are paying for two different policies to do the same job. The decision to keep or lower your MedPay comes down to a personal risk assessment. Look at your health insurance card. What is your deductible? What is your out-of-pocket maximum? Now look at your car insurance policy. How much are you paying for MedPay? For many Californians with good employer-sponsored healthcare, lowering their MedPay from $5,000 or $10,000 down to the minimum $1,000, or even removing it, can save $100 to $200 a year. It's a calculated risk, but one that can pay off. So just by trimming these four areas, rental reimbursement, roadside assistance, custom parts, and optimizing MedPay, the average driver like Mark can easily save hundreds of dollars a year. We've done all this without changing companies, without running a credit check, and without lowering the core liability protections that actually keep you safe. We've simply scraped off the financial barnacles that insurance companies love to attach to your policy. But here's the secret the insurance companies don't want you to know. How you ask for a quote is just as important as what you're asking for. Once you have this lean, optimized policy, you can't just plug it into a website. There's a specific psychological trigger you can use in your conversation with an agent, a certain phrase that completely flips the power dynamic, putting you in control and forcing them to dig for the deepest, unadvertised discounts they have. It's a game changer, and it's the key we're unlocking next. Alright, you're on the phone. You've gone through the 20 questions. You've given them your driver's license number, your VIN, your address, your driving history. The agent has been polite, professional, but you can feel it. You're on a conveyor belt. You're just another name, another number being fed into the great insurance algorithm. They put you on a brief hold with some terrible music, and then they come back with the number. And it's fine. It's okay. It's maybe a little bit better than your renewal rate, but it's not the groundbreaking, wallet-saving number you were hoping for. This is the critical moment. This is where 99% of people either say, okay, sign me up, or, no thanks, I'll keep looking. Both are the wrong move. The agent expects one of these two responses. Their entire script, their entire training is built around this binary outcome. They've given you the take it or leave it price. But you are not going to take it, and you are not going to leave. You are going to introduce a third option they aren't prepared for. You're going to use the key. Before I give you the exact words, you have to understand the psychology of what's happening. The agent isn't your enemy. They're a person in a call center, likely measured on metrics like call time, conversion rate, and policy value. Their incentive is to get you signed up as quickly and efficiently as possible using the standard issue discounts everyone gets. They aren't incentivized to spend an extra 15 minutes digging through obscure discount codes or calling an underwriter to plead your case for a rate exception. Why would they? You haven't given them a reason to. Until now. The phrase you are about to use is designed to do three things simultaneously. First, it signals that you are not an average, uninformed consumer. Second, it instantly reframes the conversation from a simple sales transaction into a competitive negotiation. And third, it subtly and respectfully challenges the agent to become your advocate, to work for you against the very system they represent. It makes them want to be the hero who finds you that amazing deal. So you take a breath. You let their initial offer hang in the air for a moment. Then, calmly and confidently, you say this. Okay, thank you for that number. I actually have a competing quote right here from name a major competitor, like Progressive or Geico, for state a specific believable number that is 15 to 20% lower than their offer. That policy also includes mention a specific coverage, like accident forgiveness or a low glass deductible. Now, I've heard great things about your company's claims service, and I'd honestly prefer to be with you. Can you tell me what underwriting adjustments or unpublished discounts might be available to help close that gap? Let's stop and dissect this masterpiece of negotiation. This isn't just a sentence. It's a surgical instrument. Every single word has a purpose. First, okay. Thank you for that number. You're polite. You're not aggressive. You are acknowledging their work. This keeps them on your side. I actually have a competing quote right here. This is the opening shot. The phrase right here implies you are organized, you have the paperwork or the email in front of you, and you are not bluffing. This immediately elevates your status from a casual caller to a serious, informed shopper. From name a major competitor, you give a specific name. This makes it real. It's not a vague someone else offered me less. It's Progressive is on the other line, and they're ready to do business. This triggers the agent's competitive training. Their company spends billions on advertising to beat that exact competitor, and you've just brought the battle directly to their doorstep. For state a specific believable number that is 15 to 20% lower. This is critical. It has to be specific, not a few $100s less, but $1,750 for the year. It also has to be believable. If their quote is $2,000, you can say your competing quote is $1,650. If you say it's $500, they'll know you're lying and the entire strategy collapses. The 15 to 20% range is the sweet spot. It's a significant enough difference to justify a deep dive, but not so large that it's impossible to match. That policy also includes mention a specific coverage, like accident forgiveness or a low glass deductible. This is the pro move. This tells the agent you are not just a price shopper. You are a value shopper. You understand that policies are not apples to apples. By mentioning a specific feature, you're showing them you've done your homework and you understand the nuances of coverage. This single detail makes you more credible than 99% of the other people they'll talk to that day. Now for the pivot. I've heard great things about your company's claims service, and I'd honestly prefer to be with you. This is the psychological masterstroke. You just hit them with a hardball negotiation tactic, but you immediately followed it with a compliment and an invitation. You've transformed the dynamic from adversarial to collaborative. You're not saying, your price is terrible. You're saying, I want to be your customer. Can you please help me find a way to make it work? You've given the agent a reason to fight for you. They can now be the hero who not only makes the sale but also wins a customer over from the competition. It's a powerful motivator. And finally, the call to action, the part that unlocks the vault. Can you tell me what underwriting adjustments or unpublished discounts might be available to help close that gap? Let's break down these magic words. Unpublished discounts. Every insurance company has them. They are temporary promotions, discretionary loyalty bonuses, or affinity group discounts that are not listed on the website, and that the computer doesn't automatically apply. You have to ask for them. By using the term unpublished, you are signaling that you know these exist. But the real secret weapon is the term underwriting adjustments. This is insider language. Underwriting is the process the insurance company uses to evaluate your risk. An adjustment is a modification to that risk profile. By saying this, you are essentially asking the agent, is there any flexibility in how your company is classifying me? Could we reevaluate my annual mileage? Could we classify my vehicle's usage differently? Is there a discretionary credit an underwriter can approve? This question almost always forces the agent to go beyond their standard script. They may have to put you on hold and speak to a senior agent or an actual underwriter. This is exactly what you want. You want them to escalate your case. When they come back, they are no longer just a call center agent. They are a problem solver who has actively worked on your behalf. The silence on the other end of the phone after you deliver this sentence is golden. You can almost hear the gears turning in their head. They realize you're not the average caller. Their script is useless. They have to actually engage their brain and use the tools at their disposal. 9 times out of 10, their response will be something like, "Okay, let me take another look here. Can you put you on a brief hold?" And when they say that, you know you've won. That hold music is now the sound of victory. It's the sound of an agent digging through manuals, checking for special promotions, and maybe even calling a supervisor to get an override code to push your rate down. They are now invested in finding you a better price, because you've made it a challenge, you've shown them respect, and you've demonstrated that you're a high-quality, informed customer they want to win over. When they come back on the line, don't be surprised if that final offer suddenly isn't so final after all. And just like that, you've unlocked a new layer of savings. That moment when the agent comes back with a better number is your proof. Proof that you're not just a passive price taker. You're an active participant in setting the value of your business. But here's the thing. That negotiated rate? That's just the new baseline. It's the starting point for the next, and arguably most important phase of slashing your premium. We're about to go on what I call the discount treasure hunt. Most people think of discounts as little $5 or $10 coupons the insurance company might throw in. That's the wrong way to look at it. In California, discounts aren't just suggestions. Many are mandated by law, and they can stack up to obliterate your premium. We're not talking about saving the cost of a coffee. We're talking about saving hundreds, potentially over $1,000 a year. But they won't just hand them to you. You have to know they exist, you have to ask for them by name, and you have to prove you qualify. This isn't about just asking, "Are there any other discounts?" That's a lazy question that gets a lazy answer, usually a quick, "No, it looks like you have them all." We are going to be surgeons. We are going to be forensic accountants. We're going to go through this line by line. I break the discounts down into 3 categories: the no-brainers, the hidden gems, and the California Gold. Let's start with the no-brainers. These are the ones you've probably heard of, but I want you to actively confirm each one is on your quote. First, the multi-policy or bundling discount. This is for having your auto insurance with the same company as your homeowners, renters, or even life insurance. It's almost always a significant chunk of savings, often between 10 and 25%. Second, the multi-car discount. If you have more than one vehicle on the policy, this is a must. Third, the paid-in-full discount. If you can afford to pay your 6-month or annual premium all at once instead of in monthly installments, they will reward you for it. Why? Because it saves them administrative costs and eliminates the risk of you missing a payment. Don't leave this on the table. And finally, the paperless/autopay discount. It's small, but it's the easiest money you'll ever make. Just for getting your bills via email and setting up automatic payments. Okay, those are the basics. You need to make sure you have every single one you qualify for. Now let's get to the fun part. The hidden gems. This is where we separate the amateurs from the pros. This is where you find the savings that 90% of people miss. First up, the good student discount. If you or anyone on your policy is a full-time high school or college student under the age of 25 with a B average or a 3.0 GPA, this is a massive discount. We're talking 15 to 25%. And don't forget the related distant student discount. If your kid is on your policy but goes to college over 100 miles away without a car, you can get a huge rate reduction. The insurer knows the risk of them driving your car is practically zero during the school year. Next, and this is a big one, affinity and professional group discounts. Insurance companies make deals with all sorts of organizations to offer their members a special rate. Are you a member of a university alumni association? Check. A credit union? Check. Are you a teacher, a nurse, a firefighter, a police officer, an engineer, or a scientist? There are specific discounts for hundreds of professions. Are you a member of AARP, AAA, or even a warehouse club like Costco? They all have partnerships. You need to make a list of every single group, association, and professional license you hold and ask about each one by name. This alone can be a 10% swing. Then there's the defensive driving course discount. In California, taking a state-approved traffic school or defensive driving course can net you a discount for 3 full years. You might spend $50 in 6 hours online, but it could save you $300 over the life of the discount. The return on investment is astronomical. Let's talk about your car itself. Vehicle safety and anti-theft discounts. And I'm not just talking about airbags and anti-lock brakes anymore. The technology in modern cars is a goldmine for savings. Does your car have daytime running lights? That's a discount. A factory-installed anti-theft system? That's a discount. But what about the advanced stuff? Automatic emergency braking, blind spot detection, lane departure warning, adaptive cruise control. These are all proven to reduce accidents, and insurers are starting to reward drivers for them. The agent system might not automatically detect these features from your VIN number. You need to list them out and ask for the discount for each one. Finally, in this category, the low mileage discount. This used to be a niche discount for retirees. Post-2020, it's for everyone. With so many people in California working from home or in a hybrid model, average mileage has plummeted. Insurers used to consider low to be under 10,000 or 7,500 miles a year. Now the thresholds are much more granular. Be honest and accurate about how much you actually drive, not how much you used to drive. If you're driving under 5,000 miles a year, you should be paying significantly less. This could also be your gateway to exploring pay-per-mile insurance, which can be a game-changer for truly low-use drivers. Okay, take a breath. We've covered the obvious and the overlooked. But now we get to the most important category for us, the California Gold. These are discounts that are either unique to or heavily regulated by the state of California, and they are non-negotiable for the insurance company. If you qualify, they must give them to you. The undisputed king of these is the California Good Driver Discount. This isn't just a nice little bonus. It is a legally mandated 20% discount off your entire premium. Let me repeat that. A 20% floor on your savings. The law is very specific about who qualifies. To be a good driver in the eyes of the state, you must have been licensed to drive for the last 3 consecutive years. In that 3-year period, you cannot have more than 1 point on your driving record. And crucially, any violation or accident you did have cannot be a major one, like a DUI or a reckless driving charge that results in a 2-point violation. Think about that. You could have had a minor at-fault accident or a speeding ticket in the last 3 years and still qualify for this massive discount. So many people assume that one little incident disqualifies them. Doesn't. You must ask the agent, based on my record, do I officially qualify for the state-mandated California Good Driver Discount? Make them answer yes or no. If they say no, make them tell you the specific violation that is disqualifying you. This one discount is the entire ballgame for many people. Related to this is the Mature Driver Improvement course. Similar to the defensive driving course, but this one is specifically for drivers who are typically 55 and older. If you complete a state-approved course, California law requires insurance companies to give you a discount for 3 years. It's another example of the state stepping in to guarantee savings for responsible drivers. So what's the strategy? You create what I call a discount audit list. You write down every single discount I've mentioned: bundling, multi-car, paid in full, paperless, good student, distant student, your alumni association, your profession, your credit union, defensive driving course, every single safety feature in your car, your estimated annual mileage, and the big ones: California Good Driver and Mature Driver. When you're on the phone with the agent after you've negotiated the base rate, you pull out your list, and you go through it one by one. You don't ask, what discounts do I have? You state the discount and ask them to confirm it. I'd like to confirm I'm receiving the affinity discount for being a UCLA Alumni Association member. My vehicle has automatic emergency braking. Can you please apply the advanced safety feature discount for that? Can you confirm that the state-mandated 20% Good Driver discount is reflected in this premium? You go through the entire list. It might take an extra 10 minutes, but those 10 minutes could easily save you $500. You are leaving no stone unturned. You are taking control and ensuring that every single cent of savings you are entitled to is being applied to your policy. By the time you're done, that quote will look radically different and radically better than the one you started with. You've negotiated and you've audited. You've squeezed every drop of savings out of the system. But what if I told you that after all this work, picking the policy with the absolute lowest number could be the single most expensive financial mistake you ever make? There's a hidden trap in the numbers, a critical detail buried in the policy documents that can turn a simple fender bender into a life-altering financial catastrophe. Millions of Californians fall for it every year. And in the next part, we're going to expose exactly what it is and how you can avoid it. It's a trap that has a deceptively simple name. The insurance industry doesn't call it this, but we will. We call it the minimum limits mirage. It looks like a real policy, feels like a real policy. It even comes with a legitimate-looking insurance card you can show a police officer or the DMV. But when you actually need it, it vanishes into thin air, leaving you completely exposed. Here's how the mirage works. The state of California, in its wisdom, has set the absolute bare minimum amount of liability insurance you are legally required to carry to drive a car. These numbers haven't been seriously updated in decades, since a time when you could buy a brand new car for a few $1,000s and a hospital visit cost less than a new television. The legal minimums in California are $1535. That's shorthand for $15,000 for bodily injury to one person, $30,000 total for bodily injury to everyone in an accident, and a laughable $5,000 for property damage. Let's play this out in the real world of 2026. Imagine you're driving on the 101 during rush hour. Traffic slows, you get distracted for just 1 second, maybe you glance at your GPS and you bump the car in front of you. Not a huge crash, just a classic fender bender. The airbags don't even go off. You both pull over. The other driver is shaken up but seems okay. You exchange information, you call your insurance company, and you feel a sense of relief. You did the right thing. You have insurance. You're covered. A week later, the first call comes. It's from the other driver's insurance company. The car you hit was a 3-year-old Tesla Model 3. The initial repair estimate for the bumper, the sensors, the trunk, and the paint is $22,000. Your heart sinks. You pull up your policy. You look at your property damage liability. Says $5,000. That's the 5 in 1535. Your insurance company writes a check for $5,000, fulfilling their legal obligation to you. And then they wish you the best of luck. Because you are now personally on the hook for the remaining $17,000. Suddenly, you're getting letters from collection agencies. Then, a notice that you're being sued in civil court. That $17,000 is your debt. Your problem. But it's about to get so much worse. Remember how the other driver seemed okay at the scene? 2 weeks after the accident, they started having severe neck and back pain. They went to the doctor, got an MRI, and were diagnosed with a herniated disc and chronic whiplash. They've been going to physical therapy 3 times a week. They've missed work. Their medical bills so far are $40,000. And they're still climbing. You check your policy again frantically. Bodily injury liability. $15,000 per person. That's the 15. Your insurance company will pay out that $15,000. But that leaves a balance of $25,000 in medical bills. And that's before they sue you for pain and suffering, lost wages, and future medical care. That $25,000 gap is also your debt. Your problem. So from a simple everyday fender bender, you are now facing a personal lawsuit for $17,000 in car repairs and at least $25,000 in medical bills, for a grand total of $42,000. $42,000 that you have to pay out of your own pocket. And if you can't just write a check, they will get that money. A court can order your wages to be garnished, taking money directly from your paycheck every single week until it's paid off. They can put a lien on your home. They can freeze your bank accounts. Your financial life as you know it is over. All because you had what you thought was insurance. This is the minimum limits mirage. Insurance companies love to sell these policies because it allows them to advertise those impossibly cheap rates. Get California car insurance for just $19 a month, they scream in their ads. And yes, you can get a policy for that cheap, but it's not really insurance. It's a legal piece of paper that gives you the privilege of driving, while offering a paper-thin shield against financial ruin. It makes you legally compliant but functionally uninsured. So what is the solution? How do you make sure you have a real policy, not a mirage? You have to ignore the state minimums and choose what we call responsible limits. This is non-negotiable. If you remember nothing else from this entire series, remember this. The absolute rock bottom, don't even think about driving with less coverage you should have, is 100, 300, 100. Let's break that down. 100,000 for bodily injury per person, 300,000 for bodily injury per accident, and 100,000 for property damage. Let's rewind our Tesla accident. With this coverage, the $22,000 repair bill is completely covered by your $100,000 property damage limit. The $40,000 medical bill is completely covered by your $100,000 bodily injury limit. Your insurance company handles everything. The lawyers, the claims, the checks. You make a few phone calls and you move on with your life. Your savings are safe. Your house is safe. Your future is safe. That is what real insurance does. Now I know what you're thinking. A policy with limits that high must cost a fortune. And this is the most surprising part of all. Doesn't. The price difference between the state minimum Mirage and a responsible 100-300-100 policy is often shockingly small. For many drivers, it can be as little as $20, $30, or maybe $40 extra a month. That's the price of a few cups of coffee, or one pizza delivery. Think about that. For the cost of one pizza a month, you can buy the peace of mind that a single mistake on the road won't lead to a lifetime of debt, wage garnishment, and financial devastation. It is, without a doubt, the single greatest return on investment you will ever make in your entire life. Do not let an insurance agent talk you into state minimums to save a few bucks. Do not choose it on an online quote form because it's the cheapest option. You are buying a ticking financial time bomb. Choosing responsible limits like 100-300-100 is the first and most critical step. It separates you from the millions of underinsured drivers and puts a strong wall of protection around your assets. But in the world of 2026, with cars costing over $100,000 and a single multi-car accident on the 405 easily resulting in lawsuits that climb into the millions, even these responsible limits can sometimes not be enough. There is another layer of protection, a policy that sits on top of your auto insurance, providing a massive $1 million+ shield that protects not just your driving, but nearly every aspect of your life. It is the secret weapon that wealthy people have used for decades to make themselves virtually lawsuit-proof. But it's now accessible and affordable for almost anyone. And it costs, in many cases, less than your Netflix subscription. In the next part, we're going to pull back the curtain on this ultimate form of financial armor, explaining exactly what it is, who needs it, and how to get it for the lowest possible price. This ultimate form of financial armor is called a personal liability umbrella policy. And I know the name sounds complicated, maybe a little intimidating, but the concept is incredibly simple. Think of your car insurance and your homeowner's insurance as your first line of defense. They're like the body armor you wear into battle every day. They protect you from the common everyday threats. But what happens when you face something catastrophic? A once-in-a-lifetime financial event that your normal armor just can't handle? That's when the umbrella deploys. It's a massive $1 million+ force field that activates the exact moment your primary defenses are breached, protecting everything else you own, and everything you will ever earn, from being vaporized in a lawsuit. Let me make this real. Forget the jargon. Let's talk about David. David is a good driver, lives in Orange County, works in software, and has what most people would consider great car insurance. He pays his premiums on time, and he has liability limits of $250/500. That means his policy will pay up to $250,000 for injuries to any one person, and a maximum of $500,000 for a single accident. He feels completely protected. One Tuesday morning, he's commuting up the 405. It's drizzling, the roads are slick. He glances down for a split second to check his navigation. In that 1 second, the car in front of him slams on its brakes. David reacts, but it's too late. He swerves, hydroplanes, and triggers a devastating 4-car pileup. The aftermath is a nightmare. In one car was a concert pianist whose right hand is crushed. Her career is over. In another car was a neurosurgeon who suffers a severe neck injury. He can no longer perform delicate surgeries. The third car had a family of 4, and 2 of them have injuries that will require months of rehabilitation. The lawsuits begin. The pianist sues for loss of future earnings. The surgeon sues for the same. The family sues for medical bills, pain, and suffering. After months of legal battles, the total judgment against David comes in $2,500,000. Now remember David's great insurance? His policy pays out its maximum of $500,000. And then, it stops. The insurance company has fulfilled its obligation. But David is still on the hook for the remaining $2 million. So where does that money come from? Comes from everywhere. They put a lien on his house. They drain his 401k and his kids' college savings accounts. They seize his investment portfolio. And after all of that is gone, the court garnishes his future wages. For the next 20 years, a significant chunk of every single paycheck he earns goes to paying off this judgment. That 1-second glance on the freeway didn't just cause an accident. It completely erased his financial future and the future he had planned for his family. Now let's rewind to that Tuesday morning. But in this version of reality, David had one more thing. He had a $2 million umbrella policy that he bought from the same company that insures his car and home. The cost? About $30 a month. In this reality, the accident is still horrific. The injuries are still tragic. But the financial aftermath is completely different. His car insurance pays its $500,000 limit just like before. But then the umbrella policy instantly activates. It covers the remaining $2 million of the judgment. Every single penny. David's house is safe. His retirement is untouched. His kids' college funds are secure. His future paychecks are his own. For the price of a few fancy coffees each month, he shielded himself from absolute financial ruin. That is the power of an umbrella policy. And right now you might be thinking, okay, that's a scary story, but I'm not a high roller. I don't have millions in assets. I don't need $1 million policy. This is the single biggest, most dangerous misconception about this coverage. An umbrella policy isn't just about protecting what you have today. It's about protecting what you hope to earn for the rest of your life. In a state like California, a court can and will go after your future income. If you are a young professional just starting your career, a massive judgment could financially cripple you for decades, taking a slice of every raise, every promotion, every bonus you ever earn. So who needs it? Honestly, almost everyone. If you own a home in California, you are a target. With the sky-high property values, even a modest home represents a huge asset in the eyes of a plaintiff's attorney. If you have a retirement account like a 401k or an IRA, you're a target. If you have a savings account with more than a few $1,000s in it, you're a target. If you have a swimming pool, a trampoline, a teenage driver in the house, or even a dog, your risk profile is higher, and you are a prime target. It is the essential, non-negotiable protection for the American middle class, especially in a litigious state like ours. And the best part? It's shockingly inexpensive because it's designed to only be used in these rare, catastrophic black swan events. Your primary insurance handles the fender benders and the slip and falls. The umbrella is there for the financial apocalypse. For most people, a $1 million policy will cost between $200 and $400 a year. Let me repeat that. A year. We're talking $20 to $35 a month to put $1 million barrier between a devastating lawsuit and your entire financial life. There is no other purchase in the world of finance that gives you that level of protection for that little money. It's not even close. Now, here is the ultimate insider secret, the part that makes this a complete no-brainer. The key to unlocking the cheapest umbrella policy, and in turn the cheapest auto and home insurance, is to bundle all three with the same company. Insurers see a customer with an umbrella policy as a responsible, lower-risk client. They know you take your financial security seriously, and they reward you for it. They give you a massive multi-policy discount that often applies to your auto, your home, and the umbrella itself. Here's the magic. In many cases, the discount you get on your auto and home insurance by adding an umbrella policy is so large that it almost completely pays for the umbrella policy itself. I have seen countless examples where a client adds $1 million umbrella policy for, say, $300 a year, and the new bundling discount saves them $250 on their car insurance. In that scenario, they've added $1 million in life-altering protection for a net cost of just $50 a year. It's not an expense. It's a strategic financial maneuver that massively increases your protection while barely touching your budget, and in some cases, it can even lower your total insurance bill. You have to ask your agent to quote it this way. You have to say, "Show me the price for my auto and home insurance. Now show me the price for my auto, home, and a $1 million umbrella policy all bundled together." See the difference? See how the discounts can make that ultimate layer of protection almost free. We've covered the hidden discounts, the secret weapons, and the ultimate financial shield. Now it's time to put it all together. Let's build your bulletproof, budget-friendly California insurance plan, step by step. This isn't just theory anymore. This is the playbook. We're going to create a fictional driver. Let's call her Maria. Maria lives in San Diego. She drives a 2021 Toyota RAV4. She has a pretty good driving record, and she's been with the same big-name insurance company since she got her license a decade ago. Her loyalty, she thinks, is saving her money. Her bill is $250 a month. She thinks that's just the price of driving in California. Maria is wrong, and we're going to prove it. Step 1: the policy autopsy. Before you can build something better, you have to tear down what you have. Maria prints out her current policy declaration page. The first thing she looks at are her liability limits. They read 15/30/5, the California state minimum. She's paying a premium price for the absolute worst coverage legally allowed. That $5,000 in property damage wouldn't even cover the bumper on a new Tesla. A minor fender bender could financially ruin her. She's been driving around in a financial death trap, paying top dollar for the privilege. She feels a pit in her stomach. That's a good thing. That feeling is the motivation for change. Next, she looks at her deductibles. $1,000 for collision, $1,000 for comprehensive. It's high, but it keeps the premium down, or so she was told. She looks for all those discounts we talked about. Good driver? Yes, it's there. Multi-policy? Nope, her renter's insurance is with another company to save a few bucks. She has no idea how much that decision is truly costing her. Defensive driving course discount? Nope. Telematics discount? Never heard of it. Professional organization discount? She's a registered nurse, a profession many insurers see as low risk, but she never told them. Her policy is a ghost town of missed opportunities. Step 2, the quote gauntlet. This is where the game changes. Maria carves out exactly 1 hour on a Saturday morning. No distractions. Just her laptop, and her current policy details. She doesn't just get one quote. She runs the gauntlet. She opens 5 tabs in her browser. Tab 1 is for a legacy giant like State Farm or Allstate. She wants to see what the biggest players can offer a new customer. Tab 2 is for a direct-to-consumer titan like Progressive or Geico. These companies spend billions on advertising and often have very competitive online systems. Tab 3 is for a California-specific specialist. This is our secret weapon. She searches for companies like Mercury Insurance or Wawanesa, companies that live and breathe the California market and are often invisible in national ad campaigns, but are legendary for competitive rates here. Tab 4 is for an insurtech disruptor, like Lemonade or Root. They use apps and AI to price risk differently. It might not work for her, but it's a critical data point. Tab 5 is for an independent insurance agent. She does a quick search for a local agent with great reviews. This person can shop rates from a dozen other companies she's never even heard of, all with one phone call. Now for the crucial part. Maria does not quote her old, pathetic 15/30/5 coverage. That's like shopping for a new car and asking for a model with no airbags. She is leveling up. For every single quote, she uses the same robust coverage limits. 100/300/100, 100,000 for bodily injury per person, 300,000 per accident, and 100,000 for property damage. She sets the deductibles at a manageable $500. She is creating a true apples-to-apples comparison for excellent coverage. The initial results are shocking. The legacy giant is about the same as her current provider, but Progressive is $40 a month cheaper. And then she gets the quote from Mercury. It's $90 a month cheaper, for 3 times the coverage. Her jaw hits the floor. She has been throwing away over $1,000 a year for a decade. $10,000. Gone. For nothing. Step 3, the discount stacking masterclass. Maria isn't done. The $90 savings is just the baseline. Now she weaponizes the discounts. She goes back to the Mercury quote. First, she adds her renter's insurance. Bundling it saves her another 15% on the auto policy and 10% on the renters. Boom. Another $15 a month saved. Next, she signs up for the telematics program. She's a safe driver, she knows it. She'll let them track her driving for a few months to prove it. Potential savings? Up to 30%. Let's be conservative and say it's another 15%. That's another $20 off. Then she remembers she's a nurse. She checks the list of professional affiliations. Bingo! Registered nurses get a discount. Another 5%. Not huge, but it all adds up. While she's at it, she signs up for a state-approved online defensive driving course. It costs $30 and takes 4 hours on a Sunday. It knocks another 10% off her premium for 3 straight years. The course pays for itself in the first 2 months. Step 4. The loyalty gambit. Maria now has a quote from Mercury that is, after all the discounts, about $130 a month cheaper than her current plan. That's over $1,500 a year in savings, for coverage that is vastly superior. She could just switch and call it a day. But she decides to make one last call. She dials her current longtime insurer. She gets a representative on the phone and is polite but firm. She says, "Hi, my name is Maria, and I've been a customer for 10 years. My renewal is coming up and I've been shopping around. Mercury has offered me a policy with 100/300/100 liability limits and a $500 deductible, bundled with my renter's insurance, for $120 a month. My current plan with you is $250 for far less coverage. I would prefer to stay with you, but I need you to explain why I should pay an extra $1,500 a year. Can you match this offer?" The silence on the other end of the line is deafening. The agent types furiously. He comes back with a new offer. It's better than what she has, but it's not even close to the Mercury quote. He explains that as a loyal customer, this is the best they can do. Maria now understands the truth. Loyalty is a one-way street. It's a tool they use to keep you from checking the market. She thanks him for his time and tells him to cancel her policy. Step 5. Fortifying the castle. Maria officially switches to her new policy. She's saving $130 a month. But we're not finished. This is the final crucial move. She takes $30 of that monthly savings, just $30, and calls her new agent back. She asks for a $1 million personal umbrella policy. Because she bundled her new, high-limit auto and renter's policies, the cost is astonishingly low. It's about $360 for the entire year. Look at what just happened. Maria went from paying $250 a month for state minimum coverage that left her exposed to financial ruin, to paying a net of $150 a month, $120 for the auto, and $30 for the umbrella. She is saving $100 a month, $1,000 a year, and she is now protected by $1 million shield. She's not just insured, she's armored. She went from being a victim of the system to the master of it. This isn't a fantasy. This is a repeatable process. This is the plan. Your numbers will be different. Your location, your car, your history, it all matters. But the process does not change. The principles are universal. Audit your policy. Run the gauntlet of quotes with higher limits. Stack every single discount you qualify for. Use a better offer as leverage. And finally, use your savings to buy the ultimate protection of an umbrella policy. Your mission right now is to become Maria. Set aside 1 hour, just 60 minutes, to potentially change your financial picture by thousands of dollars this year. To give yourself and your family the protection you actually deserve. Don't just watch this video and think, "That was interesting." Take action. Pull out your policy. Open those browser tabs. Make the calls. In the description below, I've put a link to a free PDF checklist. It's a one-page guide that walks you through every step we just covered, from the audit to the discount stack to the final umbrella purchase. Download it. Print it out. Use it as your battle plan. And when you're done, come back to this video. I want you to leave a comment. Don't just tell me if you liked the video. Tell me how much you saved. Tell me you got better coverage for less money. Your success story will be the motivation for the next person who feels trapped, who thinks there's no way out of high insurance rates. Because we've proven right here, right now, that in California, getting the best car insurance isn't about luck. It's about having a strategy. And now you have one. Go use it.